Welcome back to the Deep Dive, where we really try to cut through the noise and get to the heart of the data. Our last session on AXIS REIT's Q1 2025 results. It painted a pretty positive picture, didn't it? Strong operations, good property income growth, solid dividends. Felt like real momentum.
Exactly. That operational strength was certainly encouraging, no doubt about it. But now, as we unpack these second quarter results for 2025, a really fascinating tension starts to emerge. You see, on the surface, yes, there's still growth, but underneath, there are some, pretty significant shifts happening in the financial structure as a whole new layer of complexity. So our mission today is to get past those headlines, try to reconcile these contrasting stories, and really help you understand where AXIS REIT actually stands with this new data.
Okay, let's jump right in then. The numbers for the second quarter, ending June 30, 2025. And yeah, at first glance, the profit figures look genuinely impressive. AXIS REIT reported RM105M Million net profit for Q2. That's Malaysian ringgit, of course. That's a big jump, 20.5% year-on-year compared to, RM38.96 million last year.
Right, and revenue climbed nicely, too,
Yes.
up to RM90.25 million.
Yeah, and for the first half, net profit surged to RM96.08 million from about RM81 million. Even the earnings per unit, the EPU, got a bump, 2.32 cent versus 2.23 cent.
Mostly driven by that stronger property income, which is usually what you want to see in a REIT. Sounds great on paper.
It does sound great, but here's the twist, isn't it? The bit that might get missed. Despite all that growth, their actual cash reserves, they just plummeted dramatically. What is going on there?
It's a classic financial paradox, really.
Yeah.
You see, the healthy profit growth looks great on the income statement, right? But the cash position, the cash flow statement tells a very, very different story. A more urgent one, perhaps. Our sources show AXIS REIT's cash and cash equivalents just cratered, down 43%.
43%. Wow.
Yeah. From over RM101 million at the end of December 2024, down to just RM57.3 million by the end of June 2025. And to understand why, you got to think about profit versus actual cash in the bank, Imagine a shop selling tons looks profitable, but if customers pay late or if they're constantly paying off old loans, the bank account can still empty out.
Right. Profit isn't always cash.
Exactly. So while their net income before tax was solid, RM96.6 million for the first half, the actual cash generated from operations, it dipped slightly, down 5% to about RM87 million compared to last year's first half.
Okay, so operating cash is slightly down, but that doesn't explain a 43% drop in total cash, does it?
Oh, no, it doesn't. The main culprit here, the big reason for that sharp drop, is a massive net cash outflow from financing activities. In the first half of 2025, AXIS REIT used RM141 million in financing activities.
Used, as in cash went out.
Cash went out the door. And compare that to the same time last year, H1 2024, when they actually had a net inflow of nearly RM20 million from financing.
Wow, that's a huge swing. So, profitable business, but burning cash on the financing side.
Precisely. A significant chunk of cash is just being used to manage their existing debt and financing obligations. That could really squeeze them later on.
Okay, speaking of things that look positive, but maybe you need a closer look, the dividends. Unit holders got a nice boost. They declared a second interim distribution, 2.65 cent per unit for Q2. Payable soon, August 29th. That's a healthy increase, nearly 18% up from Q2 last year.
Yeah, 2.15 cent last year, so it's a noticeable jump. Total for the first half is 5.15 cent now.
And interestingly, 0.15 cent of that is non-taxable, thanks partly to selling the annex property, right? They got a gain there.
They did. A realized net gain of about RM8.8 million available for distribution from that sale definitely helps.
And they're sticking to distributing 99% of realized income. Sounds like a win for investors. But that sustainability question just looms larger now, doesn't it? Especially with that cash drain and the debt picture.
That's absolutely the core of the sustainability puzzle, the higher dividend. Unit holders will love it, no question. And yes, that annex disposal gain certainly helps cushion this payout, but you have to ask, is that a one-off? Are they going to rely on selling assets to keep distributions high?
Good point. What about the bigger picture on debt?
Right. The bigger picture is dominated by this. AXIS REIT is facing RM1.07 billion in short-term debt. That's under current liabilities financing as of June 30th.
1.07 billion. Due within a year.
Due within a year. It's a significant amount that needs constant refinancing, constant renegotiation. Now, we also know Bank Negara Malaysia, the central bank, just cut its key interest rate, the OPR, by 25 basis points down to 2.75%.
Which should help with borrowing costs, maybe.
You'd think so, but Public Investment Bank's research suggests the impact on REITs with floating rate debt might be minimal. maybe only a 1% to 2% reduction in interest costs. Now, XIS has about 46% of its debt on floating rates, so they'll see some benefit.
But probably not enough to make a huge difference against that billion-dollar short-term pile.
That's the concern. A tiny reduction might not be enough, especially if refinancing gets tougher or more expensive down the line. So can they keep paying out generously with that hanging over them? It's a big question mark.
That RM1.07 billion figure, it really is where the plot thickens, isn't it? What fundamentally changed in their debt strategy? Let's peel back the layers there, because the balance sheet shows this. Well, frankly, quite dramatic shift.
It is dramatic.
Their non-current liabilities, financing, that's the long-term debt, due way out, it drops significantly, down to about RM636 million from over RM934 million at the end of last year.
Right.
But conversely, the current liabilities financing the short-term stuff, due within 12 months, it surged to RM1.067 billion.
A 31% increase just since December.
Exactly. It's not a minor tweak. It's a major rebalancing. They've basically shifted almost 1 billion ringgit from long-term safety into short-term pressure. What does that signal about their stability?
Well, it certainly raises important questions, doesn't it? This huge shift towards short-term debt dramatically increases their refinancing risk. They now have to roll over a much larger chunk of debt, much more often, and potentially, probably, at whatever terms the market dictates at that moment.
It sounds stressful, like having most of your mortgage suddenly due next year instead of over 30 years.
That's a decent analogy, yeah. It means they're constantly back at the negotiation table with lenders. And like you said, 46% is floating rate. So yes, the BNM rate cut helps a tiny bit on that portion, maybe saves them 1–2% on that part of the debt.
But the sheer scale of the short-term debt.
Exactly. It means even small changes in interest rates or just shifts in how willing banks are to lend could have a magnified impact on their financing costs. It's a high-stakes bet on rates staying low and credit markets staying open.
Didn't we see total liabilities actually decrease slightly in Q1, suggesting things were getting more stable?
We did. And overall total liabilities have slightly decreased again, down to RM1.877 billion. But the crucial point is the composition. The risk profile has fundamentally changed by concentrating so much risk into the immediate future. It makes them highly sensitive to near-term shocks. And we also saw, for instance, mounting unrealized losses on their Islamic profit rate swaps, their hedging tools. A cumulative loss of nearly RM6 million in the first half this year versus a small gain last year.
So the hedges aren't quite working as planned, or underlying costs are higher.
It suggests their attempts to manage rate risk are currently costing them money on paper, hinting at potentially higher underlying financing expenses. Adds another layer of financial pressure.
Okay, so we've got these big financial shifts, a cash squeeze, and now compounding all that, there's this major legal battle looming that could hit the books even harder, right?
Yes, beyond the core financing structure, this litigation is significant.
We need to talk about the case involving Yongnam Engineering and Yongnam Holdings. AXIS REIT is chasing a huge claim, over RM105 million for unpaid rent and damages. We knew they got a judgment in default, meaning Yongnam didn't defend the claim, so AXIS technically won. But what's the latest? Is that money actually recoverable? Should investors worry about write-offs?
This is definitely a critical point for investors. The latest news is, well, not great for recovery hopes. Liquidators have now been appointed for both Yongnam entities, one in February, one in August 2024.
Liquidators, meaning bankruptcy proceedings, essentially.
Pretty much. It signals severe financial distress for Yongnam. The case is now just waiting for the next creditors meeting. But the appointment of liquidators, it casts, frankly, significant doubt over recovering anything close to that full RM105 million claim.
So a big write-off could be coming.
It's a substantial financial risk, yes. It could easily lead to future write-offs on AXIS REIT's books, impacting their asset values. And think about how this connects back
to the liquidity concerns.
Exactly. Remember that RM141 million cash burn from financing activities in the first half? That substantial cash outflow, combined with the uncertainty of getting back this large RM105 million sum, well, it could further strain their operational flexibility and cash reserves moving forward. It just tightens the screws.
Okay. Despite all these financial complexities, these headwinds, the manager sounds optimistic. They're citing the good performance of their properties, their growth strategy, buying quality assets.
And their focus on industrial and logistics properties is a genuine strength. We saw in Q1, 58 out of 69 properties were fully occupied. That's solid.
So how do we square this, the strong core business versus these growing financial risks? What does it all mean looking ahead to Q3? Is that property income enough?
You've hit on the critical tension right there. The underlying strength of that industrial portfolio, their active management, like selling the annex for a nice gain, those are undeniable positives. They provide a strong foundation. But the balance sheet strain, it's equally evident. It's a really delicate balancing act they're performing. So for you, the investor, thinking about Q3 results, there are three key things, three metrics you absolutely need to watch. Think of it like your dashboard for their financial health.
Okay, what should we be looking for?
First, short-term debt refinancing progress. Keep a very close eye on that RM1.07 billion, how much gets successfully rolled over, and crucially, at what interest rates and terms. That dictates future costs and their breathing room, their liquidity. This ties right back to our Q1 chat about overall debt levels, but now the focus is sharp. It's about the structure and the rollover risk of that debt. Are they managing these near-term financial hurdles?
Makes sense. What's number two?
Second, cash flow from operating activities. Remember, profits were up, but operating cash actually dipped slightly in the first half. Was that just a blip, or is it a trend? Robust, growing operating cash flow is absolutely vital for a REIT. It's how they should ideally sustain distributions and manage debts without constantly needing more loans or selling assets. It's the lifeblood.
Got it. Operating cash flow. And the third?
And third, the Yongnam litigation outcome. Any real update on that RM105 million recovery? Getting clarity, even if it's bad news confirming a write-off, will remove a big financial question mark. It allows for a more accurate assessment of their true asset value and future earnings potential, removes that uncertainty.
So refinancing, operating cash, and the Yongnam case outcome.
Exactly. The strength in their properties and occupancy is solid, no doubt. It's a testament to their operational skill. But the big question for Q3 is just how well that operational strength can buffer these very real financial challenges from the debt structure and liquidity demands. It's going to be fascinating to watch.
So there you have it. AXIS REIT's second quarter.
Yeah, a truly mixed picture. A really fascinating case study in financial complexity, actually. On one side, you've got robust operations, higher profits, those increased dividends investors like. Selling the annex strategically, focusing on those high-demand industrial properties, it shows a solid core business, a strong competitive moat.
Indeed. And that's reflected in our scores. Our financial score for AXIS REIT, based on this dive, is a 6 out of 10. We're acknowledging those strong operational points, the property income, but we're definitely flagging significant concerns. Liquidity is dwindling, that big risky shift to short-term debt is worrying, and those unrealized hedging losses hint at higher underlying costs.
But the moat score is higher.
But the moat score is a solid 7 out of 10. That highlights their strong, defensible position in that industrial and logistics sector. That's a key strength, absolutely. This deep dive really leaves you thinking, doesn't it? Is AXIS REIT's impressive growth just sort of papering over some underlying cracks? Vulnerabilities that could really bite if market conditions sour? Or is this actually smart, maybe aggressive, management navigating a tricky landscape really effectively, playing to their strengths? How do you, listening now, weigh that solid operational moat and the healthy property income against these mounting short-term financing risks and the cash squeeze? That's really the core question here for anyone following AXIS REITs. Definitely food for thought as we wait for Q3.
There's always more beneath the surface, isn't there? And looking at it from different angles always helps build a clearer picture.
Thanks for joining us for this deep dive into AXIS REIT's latest results. We really hope this has given you a clearer, maybe more nuanced view of what's happening behind those headline numbers.